Sustainable finance has evolved from a fringe movement into a mainstream strategy that unites economic success with environmental responsibility. In this video, we're exploring what sustainable finance truly means, how it goes beyond simply avoiding harmful industries, and instead targets ways to make a positive, measurable impact on our planet while still delivering competitive financial returns. Whether you're a seasoned investor, a business leader, or simply curious about the intersection of money and social good, this discussion offers fresh insights into how capital can be harnessed for both profit and purpose. Let's start by defining sustainable finance. At its core, it aims to steer capital toward activities that support long-term economic development, environmental health, and social well-being. Unlike traditional investing, which focuses heavily on short-term gains or purely quantitative metrics, sustainable finance factors in the broader consequences of where money is allocated. Everything from carbon emissions and labor practices to corporate governance and community impact. In essence, sustainable finance reflects the idea that long-term financial performance can be more robust when it's aligned with environmental and social resilience. Among the key drivers of sustainable finance is the rise of ESG, environmental, social, and governance criteria. Instead of merely screening out stocks or bonds linked to environmentally or ethically questionable practices, many investors now use ESG metrics to identify companies that actively seek to reduce pollution, treat their workforce equitably, and demonstrate transparent leadership. From an investment standpoint, ESG analysis can uncover hidden risks, like liabilities from pollution lawsuits or public relations scandals, and also highlight opportunities. For example, cutting-edge companies that innovate in renewable energy, fair trade supply chains, or water conservation technologies. By integrating these ESG dimensions into financial models, sustainable investors aim to discover firms better prepared for future regulatory changes, shifting consumer preferences, and resource constraints. Another major element in sustainable finance is the concept of impact investing. While ESG seeks to incorporate responsible principles into investment decisions, impact investing takes it a step further by targeting investments that offer direct, measurable social or environmental benefits. These can include green infrastructure projects, microfinance for underserved communities, or social enterprises tackling global issues like healthcare or access to clean water. Crucially, impact investors don't assume they must sacrifice returns. In fact, many successful ventures in renewable energy and inclusive fintech have delivered healthy financial gains while addressing urgent societal challenges. Government policies and global accords also accelerate the expansion of sustainable finance. International agreements on climate change, such as the Paris Agreement, have spurred governments to enact tighter emission standards, renewable energy subsidies, and climate-related disclosures for major corporations. As these frameworks evolve, companies that anticipate changing regulations can gain a strategic edge. For instance, a firm that invests early in transitioning to cleaner energy sources may avoid future compliance costs and reputational risks, making it a more attractive prospect for banks, insurers, and investors. This policy environment has also created huge demand for green bonds, where proceeds are earmarked for eco-friendly projects like solar farms or energy-efficient infrastructure. Their popularity not only helps companies and municipalities secure funding at competitive rates, but also provides investors with a tangible, transparent way to support sustainability while earning interest. Of course, sustainable finance isn't without its complexities. One ongoing challenge is greenwashing, where companies present themselves as greener or more ethical than they truly are. Some might selectively highlight minor eco-initiatives while omitting core business practices that generate large-scale environmental harm. This makes authenticity and proper measurement crucial. Investors now rely on third-party verifications, rigorous ESG ratings, and consistent public disclosures to sift through marketing spin and get a realistic view of a company's overall impact. Progress in data analytics is also helping, as satellite imaging and digital monitoring can confirm whether a mining firm is respecting land usage rights or if a textile producer is actually reducing water consumption. Another debate revolves around fiduciary duty. Some critics argue that investment managers focusing on sustainability might neglect their primary responsibility to maximize returns. However, a growing body of research counters that companies actively managing environmental and social risks often show stronger long-term performance and lower volatility. Additionally, consumer demand trends are shifting. People care more about the social and ethical dimensions of their purchases. A brand that leads on sustainability may cultivate deeper customer loyalty and thus more stable revenues. Similarly, an institution perceived as socially responsible could attract top-tier talent, further driving innovation and performance. All of this suggests that a values-based approach to finance can be quite compatible with the pursuit of profit. In the corporate lending sphere, banks and venture capitalists are also adapting to sustainable finance. Traditional lenders now incorporate ESG metrics into credit risk assessments, meaning companies with questionable environmental or labor practices might face higher borrowing costs or even rejection. Meanwhile, some venture capital firms specialize in early-stage clean tech or social ventures, blending growth potential with meaningful impact. These specialized funds don't just write checks, they often provide mentorship, sector expertise, and introductions to global networks, accelerating the growth of companies aligned with the emerging impact economy. For individual investors, sustainable finance can be as straightforward as picking ESG-focused mutual funds or exchange-traded funds, ETFs. Many brokerages now label funds explicitly by their ESG stance, offering transparency on which holdings meet certain criteria. This is especially appealing for people who want their portfolios to reflect personal values, like promoting renewable energy or diversity in leadership, without having to analyze companies one by one. However, it's wise to compare different ESG fund methodologies. Not all providers use the same definitions or scoring systems, so some might be less rigorous than others. Conducting due diligence or seeking professional guidance can help ensure your ESG investments align with your ethical goals and financial objectives. Looking ahead, technology will play an ever-growing role in sustainable finance. Advanced analytics, AI-driven screening tools, and blockchain-based solutions could boost transparency, track carbon credits more efficiently, and reduce fraud in supply chains, all of which reinforce investor confidence in sustainability-oriented ventures. Innovations in peer-to-peer lending platforms for green projects or tokenized carbon assets might also expand access to impact investing, allowing more people to participate directly. Despite the progress, challenges remain. Standardizing ESG metrics is a work in progress, leaving room for inconsistencies. Developing countries still struggle to access sufficient green funding to modernize infrastructure without further harming the environment. And while institutional investors are pouring billions into sustainable ventures, the scale of global issues like climate change, resource depletion, and income inequality demands far greater levels of capital. Yet these very challenges also present opportunities for new financing models, cross-sector collaborations, and policy-driven investment strategies that could help shape a more resilient global economy. At its heart, sustainable finance is about rethinking the purpose of capital. Profits remain essential, but so is acknowledging that environmental and social stability are prerequisites for markets to thrive over the long haul. A company operating in a polluted environment or in a region plagued by climate-linked disasters will find it harder to maintain consistent profits or workforce morale. Conversely, a business that invests in renewable technologies, fosters workforce diversity, and commits to ethical supply chains is far more likely to be around and growing decades down the road. As an individual, whether you're an entrepreneur, investor, or executive, exploring sustainable finance can open doors to a future where profitability and responsibility reinforce one another rather than clash. You might decide to shift a segment of your portfolio to ESG funds, or look for ways your company can decarbonize operations and earn positive media coverage in the process. You might even launch a startup tackling a social problem that conventional players have overlooked. The possibilities are broad, but the underlying principle remains: doing well financially and doing good socially are no longer mutually exclusive goals. In summary, sustainable finance stands at the crossroads of strong returns and ethical responsibility. It's an evolving discipline fueled by mounting consumer awareness, regulatory focus, and technology-driven transparency. By investing in companies that champion environmental stewardship and social justice, or by steering your own business along those lines, you're not only embracing the future of finance, you're helping define it. If you're ready to align your financial moves with broader societal interests, sustainable finance offers an actionable framework. The question is no longer whether you can make money while making a difference. It's whether you can afford not to, in a world that increasingly rewards those who invest in a healthier planet and more equitable societies. Thank you for watching. If you found this video helpful or inspiring, remember to subscribe and share. We'll continue exploring how finance is evolving to meet the challenges and opportunities of tomorrow, from cutting-edge investment vehicles to corporate responsibility strategies. Until next time, stay informed, stay curious, and invest in a future that benefits everyone. Imagine transforming your business or investment portfolio in such a way that, over time, you add an extra $34 million to your bottom line. This isn't about overnight luck or a single magic bullet idea. It's the result of consistently applying a range of strategies designed to drive growth, optimize operations, and seize opportunities when they arise. In this video, we'll walk you through a comprehensive roadmap for building substantial wealth, drawing on tactics that successful entrepreneurs, savvy investors, and seasoned executives use every day. By focusing on practical techniques, forward-thinking leadership, and intelligent decision-making, you can position yourself to generate millions in additional value over time. Let's begin with the core concept of scalable revenue generation. At its heart, generating significant wealth is about building systems that consistently bring in revenue. For many businesses, this means refining the sales process, expanding into new markets, and developing a product or service that solves a real problem. Start by identifying the unique value proposition of your business. What can you offer that no one else can? Once you have that clarity, invest in building a sales and marketing engine that reaches more customers. Consider expanding your distribution channels, whether through e-commerce platforms, strategic partnerships, or even international expansion to multiply your revenue streams. As you broaden your reach, be sure to maintain quality and customer satisfaction, because sustainable growth relies on repeat business and positive word of mouth. Beyond scaling sales, another critical pillar is cost efficiency and margin improvement. Even if your revenue is growing, the path to millions lies in how effectively you manage your costs. Analyze every aspect of your operations to identify areas for improvement. Could you negotiate better rates with suppliers or adopt lean manufacturing techniques to reduce waste? Perhaps there's an opportunity to automate routine tasks using modern technology. Every percentage point saved in costs directly boosts your profit margins, and over time, these small gains can add up to millions. Moreover, a disciplined approach to cost control enables you to invest more aggressively in growth initiatives without over-leveraging your business. Once your revenue and margins are optimized, the next step is strategic reinvestment. The idea is simple. Use a portion of your profits to fuel further growth. This might mean launching new product lines, entering adjacent markets, or upgrading your technology infrastructure. A disciplined reinvestment strategy ensures that your business not only remains competitive, but also continues to expand its market share. Look for projects with high returns on investment, ROI, and be willing to experiment with the innovative ideas. Sometimes the investments that seem risky on paper can yield tremendous rewards if executed properly. It's essential, however, to maintain a balanced portfolio of initiatives so that you're not putting all your eggs in one basket. In addition to growing your existing business, diversification is a key element in generating significant wealth. Diversification isn't just about spreading risk, it's about seizing opportunities across different sectors and asset classes. For instance, while your primary business might be thriving, you could allocate part of your capital to emerging industries such as technology startups, renewable energy projects, or even real estate ventures in high-growth areas. By diversifying your investments, you create multiple revenue streams that can cushion you against downturns in any single market. Each additional venture, if chosen wisely, adds another layer of potential income and wealth creation. The goal is to build a robust financial ecosystem where different parts of your portfolio support and reinforce each other. Another important strategy is leveraging financing to accelerate growth without sacrificing control. Many successful entrepreneurs use debt wisely to expand their operations faster than they could solely through retained earnings. For example, securing a modest bank loan or partnering with a private equity firm can provide the necessary capital to scale up operations, enter new markets, or invest in cutting-edge technology. The key here is to use leverage in a controlled manner, ensuring that the additional debt is serviceable through increased cash flow. When structured properly, external financing can multiply your growth rate and, in turn, the value of your company. However, it requires a solid business plan, accurate financial forecasting, and disciplined management to avoid overextension. An often overlooked aspect of wealth creation is the power of negotiation and deal-making. Whether you're acquiring a smaller competitor, striking a strategic partnership, or negotiating supplier contracts, strong negotiation skills can unlock tremendous value. Learn to identify win-win scenarios where both parties benefit from the transaction and don't be afraid to walk away from deals that don't meet your criteria. Every successful negotiation should result in improved margins, reduced costs, or expanded market access. Mastering this art can help you secure favorable terms that directly boost your bottom line over time. Networking also plays an essential role in building wealth. The right connections can open doors to investment opportunities, partnerships, and industry insights that might otherwise be out of reach. Attend industry conferences, join professional organizations, and cultivate relationships with mentors and peers who have already navigated the challenges of scaling a business. These relationships not only provide valuable advice and support, but can also lead to introductions to investors or potential clients. In many cases, the growth of a business is as much about the quality of its relationships as it is about its product or service. Strong networks can help you identify emerging trends and make informed decisions that put you ahead of the competition. In today's digital age, technology is an indispensable tool for wealth creation. Embracing digital transformation can dramatically improve efficiency, streamline operations, and enhance customer engagement. Whether it's using data analytics to optimize your marketing campaigns or investing in automation to reduce labor costs, technology enables you to scale your operations rapidly while maintaining quality. For example, cloud computing and artificial intelligence can provide real-time insights into consumer behavior, allowing you to tailor your offerings more precisely to market demands. Furthermore, digital platforms can extend your reach far beyond traditional geographic boundaries, opening up global markets that were once inaccessible. Innovation is another critical driver of substantial wealth. To generate significant returns, you must be willing to challenge the status quo and pioneer new approaches within your industry. Innovation can take many forms: product innovation, process innovation, or even business model innovation. Look for opportunities to disrupt conventional practices, perhaps by introducing a subscription-based service model instead of one-time sales, or by leveraging mobile technology to deliver personalized customer experiences. A culture of continuous improvement and creativity not only attracts top talent, but also ensures that your business remains dynamic and competitive. Over time, these innovative practices can lead to exponential growth in revenue and market share. Intellectual property, IP, is yet another asset that can significantly contribute to wealth creation. Patents, trademarks, copyrights, and trade secrets can all serve as valuable assets that not only protect your innovations, but also create additional revenue streams. Licensing your IP to other companies, for instance, can generate a steady income without requiring additional capital expenditure. Moreover, strong IP portfolios enhance your company's competitive advantage and can significantly boost its valuation in the eyes of investors. Protecting and monetizing your intellectual property should be a core component of any long-term wealth-building strategy. Another aspect to consider is the importance of financial discipline and rigorous performance measurement. Successful wealth builders consistently track their progress, analyze key performance indicators, KPIs, and adjust their strategies based on data. Whether it's monitoring cash flow, profit margins, or customer acquisition costs, having a clear understanding of your financial metrics is critical for making informed decisions. Use financial dashboards and reporting tools to stay on top of your performance, and don't be afraid to pivot if certain strategies aren't delivering the expected results. In a fast-changing market, agility and responsiveness can mean the difference between stagnation and rapid growth. In addition to internal measures, external benchmarking is invaluable. Compare your performance with industry peers to identify areas where you're excelling and areas that need improvement. Understanding how similar companies are navigating challenges can provide fresh ideas and highlight best practices that you might adopt. Moreover, engaging with industry analysts and participating in market research can offer insights into broader trends that could impact your business. A proactive approach to benchmarking helps ensure that you remain competitive and well-positioned to capitalize on emerging opportunities. Effective risk management is also paramount when striving to generate significant wealth. Every growth strategy carries inherent risks, whether they stem from market fluctuations, operational challenges, or unforeseen economic events. Establish a robust risk management framework that identifies potential vulnerabilities and outlines contingency plans. Diversify your revenue streams and investments to mitigate risks associated with any single market or product. Consider establishing reserve funds or purchasing appropriate insurance policies to safeguard against unexpected setbacks. By anticipating potential challenges and preparing accordingly, you not only protect your existing assets, but also create a solid foundation for sustainable growth. A crucial component of wealth creation that often goes underestimated is personal mindset and leadership. The journey to generating millions of dollars is as much about internal resilience as it is about external strategies. Cultivate a mindset of continuous learning, embrace failure as an opportunity to improve, and maintain a relentless focus on your long-term vision. Strong leadership inspires your team, drives innovation, and builds a culture of accountability and excellence throughout your organization. The ability to motivate others and drive collective progress can be a significant force multiplier in achieving ambitious financial goals. Strategic partnerships can also provide a significant boost in your quest to generate substantial wealth. By collaborating with complementary businesses, you can access new customer bases, share resources, and leverage each other's strengths to create mutually beneficial outcomes. Forming alliances with suppliers, distributors, or even competitors can lead to economies of scale and cost savings that would be difficult to achieve independently. These partnerships often open the door to new market opportunities and provide the critical support needed during rapid expansion phases. The key is to identify partners who share your vision and are committed to delivering value over the long term. Finally, as you implement these strategies, it's essential to remain adaptable. Markets change, consumer preferences evolve, and new technologies emerge at a rapid pace. The strategies that work today might not be as effective tomorrow, so continuous innovation and willingness to adjust your approach are vital. Regularly review your business model, update your forecasts, and be open to experimenting with new ideas. The most successful wealth builders are those who can pivot quickly in response to changing circumstances without losing sight of their long-term objectives. In summary, generating $34 million in additional wealth is not a single-step process, but a multifaceted journey that combines scalable revenue generation, cost optimization, strategic reinvestment, diversification, effective use of leverage, and disciplined risk management. It requires a commitment to continuous improvement, strong leadership, and the ability to adapt to an ever-changing market landscape. By integrating these diverse strategies, ranging from optimizing operations and innovating product offerings to forming strategic partnerships and investing in technology, you create a powerful engine for growth that compounds over time. If you're ready to take control of your financial destiny, start by assessing your current position, identifying areas for improvement, and developing a clear plan of action. Whether you're an entrepreneur looking to scale your business, a corporate executive aiming to enhance operational efficiency, or an investor seeking robust opportunities, these proven strategies provide a roadmap to building substantial wealth. Remember, every decision you make today, from negotiating better terms with suppliers to investing in next-generation technology, can bring you one step closer to that $34 million milestone. Thank you for joining this deep dive into the strategies that drive long-term financial success. If you found these insights valuable, subscribe and hit the notification bell for more actionable advice on building wealth, scaling your business, and mastering the art of financial strategy. Now is the time to transform your vision into reality. Start taking the steps today that will pave the way for millions in future growth.